been a pretty big move over the past couple of weeks. We broke the 200-day moving average. We accelerated quite significantly after that, briefly got below 7 and, kind of right around those levels at the moment. Our opinion is that this is not the start of a strong CNY trend, and we think that in the second half of the year, there's probably risks of it being in the 720 to 730 range. And there's a couple reasons for that. The first one is that the fair value tariff level for CNY is 705, and that should act as an anchor for the currency. I think risk premia ahead of the U.S. elections is probably higher than what the market's priced, and we still have a lot of global growth uncertainty with risks, in our opinion, being skewed to the downside. So we think from here, it's maybe a little bit more balanced than it's been in the past, but there's still more risk for the CNY to weaken rather than get stronger from these levels.
Jason, where do you think the market's getting it wrong then, specifically with the U.S. election risk premium?
Well, I think both sides in, the U.S. and China have, talked about, proper implementation of a phase one deal. But, the U.S. economy is not in great shape. Trump is quite far behind in the polls. And there's still a lot of uncertainty as far as what that election strategy could be over the next 3 to 4 months. So, we've seen, escalation in different areas, and that could continue to increase going forward.
Sure, Jason, but I want to get a bit more on your projection of 7.20, 7.30 on the yuan, because a large part of the story with regards to the yuan strength has been more about China opening up its financial markets, there being a flood of money getting into China assets, both fixed income and equities, and the economy doing a whole lot better than the rest of the region, given the clampdown on the pandemic. Do you not see that to be the case? That would support the yuan's move and arrest its downside risk from here?
Well, if you look over this year, CNY versus its trading peers, such as the Korean won, for instance, we've been in a fairly narrow range. So I would say the driver of the currency market is probably less to do with China-specific issues and more to do with what's happening with the dollar overall. And in that context, we think that, EM currencies as a group, could weaken over the next 6 to 12 months because of growth factors and capital flow factors. Now, as you mentioned, China is unique because of a very big pull factor from index inclusion in bonds and equities. And that's good for China, but not good for everybody else. And if the rest of EM is weakening, there's a limit to how much CNY could be how much CNY could strengthen, and more likely it'll follow the general pattern of the dollar versus yen.